A recent AM Best webinar looked at the current state of the global reinsurance market. The webinar began by assessing the current reinsurance environment and the factors shaping it.
As you know, Meg, in January, AM Best revised its outlook on the global reinsurance market from negative to stable. And I do want to emphasize that it's a market outlook, not a rating outlook. The reason why we went stable is not necessarily because we felt the environment had improved substantially, but rather because we felt that following the events of 17 and 18, that pricing was more likely to stabilize and that return metrics probably did hit bottom for the sector. So January renewals showed a little bit of promise, not as much as we would have hoped, but certainly the June renewals were more promising. I think the thing that one has to keep in mind is that the improvement has been isolated. Not all classes of business and segments, improved to the same degree, but certainly, loss-affected U.S. property cat, and Asian cat classes of business showed the most dynamic improvement. And the other important factor to consider is that alternative capital appears to be more disciplined, and hopefully that will remain the case going forward, and that should bear well for pricing over the near term.
I'd say we're probably in a more challenging and complex environment. We definitely have more loss severity that we've seen in the last couple of years. We've got risks that are increasingly more complex, such as cyber, even terrorism. And then you complicate that with the fact that we've got a low interest rate environment that's been created more recently over the last 10 years. And then I think you can couple that with the fact that you've got the impact of technology on the industry that's increasing rapidly and changing the way we're distributing and underwriting in the sector. So overall, I'd say there's a greater emphasis on creating value for your clients, understanding the risks, and emphasizing your scale and having more of a global reach to meet these demands.
I would echo what Bob and Mark have both said. I think that we're in a little bit of a state of flux where the market had changed considerably. The third-party capital entering, particularly the property catastrophe space, has pushed other companies to diversify that used to get a lot of their earnings from that. And you've seen ROEs trend considerably lower, combined ratios trend a little bit higher. And I think now that we've almost reached the state of equilibrium where it's moving on to another phase of development.
So turning to the rate of return, what's an acceptable rate of return an investor should expect given current market conditions?
Well, I would probably or eventually defer to Mark or Mario, but generally I think it's about 5% above the risk-free rate. So if you're thinking about U.S. Treasuries, and as you take on more risk, it's going to tick up, and if it's going to be less risky or perceived to be less risky, you probably accept something a little bit lower.
I think it depends largely on the risk appetite of the investor.
Probably the time horizon as well, too.
Yeah, and the time horizon. Plus, I mean, it's an uncorrelated risk with equities, generally speaking, the lion's share anyways. And the diversification benefit that some institutional investors, pension funds, receive from it is huge. So it really reduces, I think, the capital factor that they would apply against it, and hence what might be perceived as a lower margin for the risk is more attractive because of that diversifying element to it.
Because as we were talking about with the parametric trigger, if it's a wind speed of a Florida hurricane, it doesn't really correlate with the wider macroeconomic environment. Is that fair to say?
Yeah, exactly.
Mario, what are your thoughts on how technology is impacting the industry?
I think the biggest impact will be on primary distribution, less so reinsurance, because the broker have a strong market power in our industry. What I can see in terms of reduced distribution cost is industry consolidation. That may play a better role than technology. Life and health insurance, the top 6 life and health insurance in the market control 90% of the business, and most of the distribution is direct. It's not broker intermediated. So you may envisage that if you have consolidation in the non-life insurance, you end up with 5-10 larger insurers. You may start seeing a more direct approach to client, helping disintermediate the brokers. and Swiss and Munich already have some form of direct distribution. But I see this as more a form to reduce distribution costs for our industry than technology.
You can view this webinar in its entirety by logging on to ambest.com.